Web3 financifies everything. Essentially, it commoditizes, what we used to call as a category fintech. So in the same way that AI is going to be irrelevant, not irrelevant as a construct, but irrelevant as a term, because everything has AI, we think the same is true for fintech, as in we're not going to distinguish a fintech company anymore because fintech is integrated into everything we do because of tokenization.
None of the information in this podcast constitutes investment advice or an offer, recommendation, or solicitation by WAGMI Ventures or any of its affiliates to buy or sell any securities.
Hey everyone, Benga here with another WAGMI Ventures podcast episode, bringing you more insights from exciting world of AI and crypto. Today I'm joined by Yat Sri. Yat is a Hong Kong-based entrepreneur, angel investor, and pioneer in blockchain, gaming, and open metaverse. He is the co-founder and executive chairman of Animoca Brands, a global leader in blockchain gaming, digital property rights, currently valued at $5.9 billion off the recent funding round. For anyone who is new, this is the WAGMI Ventures podcast, where we do snapshots with interesting builders, founders, investors across crypto and AI. Check out wagmiventures.io to learn more about the syndicate behind the podcast. All right, friends, let's get into it. This is going to be a very insightful conversation with Yat. Yat, we're really honored to have you on. Thanks for joining us.
Thank you for having me. It's a real pleasure to be here.
Awesome. You've described Web3 as enabling a form of stakeholder capitalism that reframes traditional economic models. How do you see Animoca Brands evolving this concept in 2025?
Thanks for the question. So maybe in terms of what we mean by stakeholder capitalism, is that what we mean is that through tokenization, the relationships you have with both your shareholders and your customers is one of common stakeholders that all have a common stake in each other. As in, whether they hold NFTs or they hold tokens, the entire network is basically now within the same kind of, let's call it, incentive network. When you look at, for instance, traditional companies, particularly in the Web2 space, you take a look at something, say, like a sort of a Facebook as a shareholder and Instagram as a product. The fact that you have millions of followers of Instagram actually gives you zero financial bearing or interest in the equity of Facebook. Likewise, you could be a really large shareholder in Facebook, and it gives you zero interest or bearing in terms of your impact on Instagram, right? And actually what happens then is you have essentially two entire communities that are all within the same vested stake, meaning that someone who's a shareholder in Facebook should be interested in the product that Facebook has, but actually they're completely disjointed and they don't communicate with each other because they're not part of the same network. And what happens then is that in today's world, we have this problem where corporations don't prioritize their customers, they prioritize their shareholders, which is a small base in terms of whether it's earnings or value. And so that means that actually the relationship they have with their customers is one purely of extraction, when that's actually not very healthy. And so the relationships, therefore, means that they become adversarial between the shareholders and the actual sort of customers, which are technically what people would describe as stakeholders. And so what we have with tokenization now is you have a way where everyone is really together connected within that same network. If you have a token and I have a token, there's an interesting aspect around democratizing not just access, but also relationships, right? Because there's no distinction anymore between you, the shareholder, and you, the customer, because we're all token holders and we're all part of the community. You could have more tokens than me, but we're still all incentivized to be in the same common network. And from a relationship standpoint, the company also has one where everyone is a stakeholder and everyone is a participant and benefits from, essentially the network that whatever system that you're looking to build. And I think just waxing a little bit lyrical here in terms of what the problem we have is not capitalism per se. Capitalism is actually, I think, the engine of growth for entrepreneurialism and really for the advancement of property rights and, as a result, of course, more freedoms that we have in the world globally. But the problem is that only a small number of people really benefit from capitalism because they understand money and they're the ones who actually have a stake in stuff. Right? So if you're a shareholder in, say, Apple or Facebook or Google, or if you're the owner of your house, you're good, right? But if you're the Apple user, you're actually buying product that benefits the shareholder. Sure, you might enjoy the product, but you actually don't have any benefit. And yet at the same time, every time you use an Apple product, you're actually promoting it if it's basically to share photos or they see your iPhone that you're holding. But I just think of all the hundreds of millions of people who have iPhones. Most of them, 99.9% of them, are not shareholders in Apple. And yet here they are promoting the product, growing it, talking great things about it maybe, or using it, adding to the network and not having a benefit of it. And I actually think that's actually a problem. And so stakeholder capitalism changes it in a way where every customer is essentially an owner in that network. And imagine what the world would look like if every one of your customers was actually also a stakeholder in you and had in some degree a kind of financial interest and a financial stake. They become much more vested in your success. They become much more loyal and much more sort of interested in your business. And we saw this with the NFTs. When people had NFTs, and actually token holders as well, there was a kind of sort of communion between other NFT or token holders because they all basically were banding together for common purpose and aligned within the same sort of incentives that they're trying to put forward. So I think that's just a better way of just building businesses. And it's also much more inclusive because now everyone can be a stakeholder. And we used to talk about this stuff like in terms of citizenship, right? So you could be a stakeholder in a nation and in a country, but in a capitalist environment, what good is it to be a citizen when you don't have ownership? And we have this problem in the world now where there's a whole bunch of people who own the land that they live on, and actually more people who don't own land. And you have a division between the two, and they are not feeling the same inclusion. And I think, again, stakeholder capitalism can help change that.
Yeah, I think the theme, the underlying sentiment there just actually carries through not just what we see today in blockchain, but in the blockchain space, but just across all spheres of life. And yeah, I think it's a very interesting concept when you break it down. It's actually one of the reasons I don't like wearing a lot of designer brands, because you are a walking billboard for the brand. But the way you frame it, it's very important in how we view ownership and how tokenization can certainly help accelerate and advance that.
Imagine, though, just to add to this, that you were a shareholder in one of those luxury brands or you had a financial stake in it because you're a stakeholder, then maybe you would be very fine to be a walking billboard. And actually, that's kind of what with people who own tokens or NFTs, right? They become effectively digital walking billboards, putting it as a PFP, showing off the product. And I think one of the things that puzzles so many people in the Web2 space is that fanatic loyalty that with token communities, right? The way that networks form, we could look at it from a form of capital appreciation. It happens very quickly in Web3 as well. But the community sort of formation is what actually gives it power because everyone has a sort of vested stake in it. And I actually think that's one of the sort of, I think luxury brands get this, fan engagement brands get this because in a way, that's what they're doing, but without ownership. And now you can give ownership to your customers, which actually makes it so much more powerful.
Yep, 100%. Just switching gears to another interesting comment that you had shared recently is the potential use case for blockchain with student loans. And I think you highlighted that could really be another, outside of stablecoins, hero use case where blockchain can advance how we solve or make that space more efficient. And I think you're championing the Open Campus initiative. Would love to understand and help our audience understand how Animoca is working to integrate crypto into education systems globally, and maybe talk about some specific barriers that you anticipate.
Sure. Happy to go over the challenges as well. Of course, if there were no challenges, then probably there's not a problem worth fixing. So first of all, one of the realizations that we had when we entered the space was that when you do something in Web3 and crypto, it essentially becomes financified, and it becomes so much more powerful when you find a financial solution to it in some form or fashion. In the case of gaming, it was things like basically ownership, which then allowed you to trade it, which had a financial outcome. And for DeFi, obviously, that's obvious. Tokenization, again, more access, more democratized access to financial instruments of some form. Stablecoins, more distribution, wider access, offering access to the dollar for people who are unbanked in places like Philippines or Africa or so on. So you see that thematic sort of expanding around essentially a financial narrative that is better for the end user, right? Transactions and that kind of stuff, cross-border trade. So we were looking for the area that was necessary and appealing for sort of the younger generations that had a financial outcome or a financially important outcome, because we realized that when you solve something financially, the adoption rate is just much better. And I think that's one of the struggles that when you think about, for instance, moving a Web 2 gamer into Web 3, you could do that very easily by giving them a wallet. But 9 out of 10 times, they don't know why they have a wallet and they don't get it because they didn't play the game for a financial outcome. Versus, of course, there's some games people play for financial outcomes and they grew much faster. So I was looking at it from that lens. What are actually some of the biggest problems we have in finance? Which is really, if you think about it, a lot of blockchain companies are trying to solve that particular lens. And so we came with education with Open Campus, which is the EDU chain. We were looking to solve things like, how do we get IP rights with teachers with NFTs, having them earn more money? Teachers are generally underpaid in the sector. And then we discovered that actually student loans is a $3 trillion market globally, okay, which has horrible outcomes for the students because of high interest rates, lack of transparency, all that type of stuff, particularly in places that are a little bit more developing, like the Philippines and Indonesia, for instance. And what does blockchain and DeFi do really well? Better, faster, cheaper. And what we discovered is that if you actually take sort of something even like stables and you basically create better yield from that and use that as collateral, you could actually get an outcome where the lender gets more yield and the student pays less interest. And that's a very obvious use case that is not just beneficial for society, but is very easy for a student who needs a loan, which, by the way, is hundreds of millions of students out there, for them to use that. And it's a very clear narrative here why you do that. And of course, the yield isn't backed by, it doesn't come from like some kind of token emission that arguably is still trying to find its value. It comes from interest payments that basically the students pay on top, right? So there's double security attached to it that you can put forward. So we ended up financing a company that came through essentially our accelerator at Open Campus called Pencil Finance that built basically this solution. We ended up providing the first $10 million of financing for student loans, working through student loan facilitators who basically provide the loans. But now the student who receives the loan has to pay back his loan with crypto. So that means he has to have a wallet, right? And so he's already onboarded. But now that he has a wallet and is dealing with his sort of, let's call it student loans that way, he can become the target of an airdrop. He could have a Mocha ID and he would be able to earn essentially value that way. So it becomes not just the gateway of getting a cheaper loan, it becomes a gateway for new forms of making money or new forms of virtual jobs. And so you can see how that flywheel works. And maybe they get the cash and maybe they pay down their loan that way, whatever. The point is that it is, I think, a very powerful use case, which actually solves a lot of problems in a $3 trillion market. And so imagine if you took just 10% of all of that student loan capital, sort of student loans, and actually put that on chain on DeFi. That's basically 300 billion, which basically triples the size of all TVL we have today in Web3. So you can see how nobody said it's easy, but if we succeed, it's going to have a massive impact, not just for the students and of course that entire sort of society, but also for just basically increasing TVL and value on chain.
Yeah, no, you're absolutely right.
Hey everybody, quick thing here. We're excited to announce WAGMI Advisory, your home for all things fundraising, hiring, and partnerships. This is all about supercharging your project with the WAGMI network, consisting of over 20,000 executives, investors, and builders in crypto, all ready to come alongside your project to help it succeed. Get in touch at team@wagmiventures.io to learn more and figure out if WAGMI Advisory is the right fit for your project. Let's get back to the show.
I'm actually curious, have you seen much engagement or traction since the launch of the initiative?
There's a lot of traction. In fact, the providers, the one who provide loans, are the ones who are really trying to lobby it. And first of all, just to be clear, there is no shortage. There's no shortage of people who want more loans for students. So that's not the issue. The demand side is virtually unlimited. So it's just how to manage the supply side in the best way. And again, the nice thing about that is that right now we're doing it in stables, but eventually maybe you could use Bitcoin as collateral, as a security, and then use that as a way for student loans. Because there's a ton of Bitcoin that's sitting around that's basically not really generating a yield. So there could be some examples around that. And the other thing that we also love about this, of course, is that I just had a something sort of government related meetup, and there were some, let's call it older people who didn't own crypto, and And they're like, what's crypto good for? And like, it's like, oh, Bitcoin, I don't get it. It's like the value is nothing. All that kind of typical stuff that people say about it when they don't understand. But when you say crypto can actually reduce student loans, the cost of student loans, and just be a better, more efficient system, and actually provide student loans even places that are unbanked, then even if they're critical to it, you have to just sit back and say, okay, that's interesting. Why does it do that? How does it work? Because it's a problem that you're solving that's fundamentally something that everyone realizes needs to be solved. So many people in the world have had to deal with student loans, right? So it means that even the most successful people have probably had a student loan at some point in their life, or had a family member or someone that they know deal with it and struggle through that. So there's a lot of empathy as well. It's something that touches everyone, indirectly or directly, because we've all had to deal with financing our education in one form or the other, right? So we think of that as a very strong use case. And you talk to government officials about it, they love it, right? So I think we need more of those type of use cases and more of these kind of positive narratives that crypto can help solve.
I'm 100% aligned there with you. And I think one of the other emerging technologies that we discuss on this show is AI. And I know you've discussed AI's role in enhancing transparency and trust in Web3 gaming, but would also love to hear your thoughts on how Animoca is approaching AI and potentially any bold predictions that you have
Sure.
for AI's impact in the space overall and in, let's say, in the metaverse.
So generally speaking, the view that we take on AI, which is, by the way, how we view essentially tokenization as well, and the early days of the internet, is that we're not going to talk about AI companies or AI use cases because everything's going to be AI, right? So if you basically don't use AI at your work, then, or as an individual, you basically slowly will become obsolete. It's kind of like if you don't have a smartphone today, or say even 10 years ago, right? You become obsolete as well. Even if you would have been happy with your BlackBerry, you have to have a smartphone, right? So AI is definitely going on that way. We use internally AI for art, for vibe coding, for basically even for an investment analysis, right? There's so many things we can do that makes it faster and more efficient, and actually in many cases cheaper. So we use that from a tooling standpoint. But I think what really, if I was to say how we think AI is going to develop, above and beyond leveraging it as a tool, is that because of crypto specifically and the ability for an AI to produce essentially a token or trade a token on chain, because you don't have to have a bank account, you don't need KYC, you can do everything on DeFi as an AI agent. And to be clear, when we talk about things like Mocha ID, we do think that an AI agent can have a good reputation and can have an ID of their own. And we would basically respect that because they might make good decisions, even if it's an AI. And here's the key point. It's not just that crypto is the natural currency for a digitally native construct like AI. It's the fact that AIs have the ability to create their own token and therefore create value, meaning that they now have a form of power that they didn't have before. So when we talk about agentic AI, we think of something that can individually do something. Now we talk about an AI that has really true agency because they now have the ability to have money, which gives them power. And so when you talk about a bold prediction, which frankly I don't think is that bold, but if I had to put out a prediction, we're going to be working for AI agents. We're going to be working for AI protocols. And to some degree, we already are in direct and indirect ways. And we're happy to do so because we get paid in some kind of currency that they've either generated, traded, or made, that then basically I can use some kind of tender somewhere around the world, probably in the metaverse or something like that, right? So I think we're going to have jobs that we're going to be working for or doing gig stuff that is essentially not a human. It's an AI agent that might even be running totally independently at this point. And if you give it the right data, it's going to pay you basically in tokens that you can then monetize, right? And when you look at, for instance, like airdrops, which are mostly given by Web3 gaming protocols and that kind of stuff, over the last 4 years or so, something like $48 billion of airdrops was delivered to users and on a protocol level. And sure, there's humans behind it, but the people who are receiving these airdrops don't know the team members that are working on this, don't know the background around this. They're really just interacting with a protocol. And when you took a look at it that way, what's the difference between a protocol and an AI agent? Not that much.
Yeah, I think that is a pretty bold prediction, that we would be working for AI agents. It would be interesting, though, to think about like what the use cases where we actually interact with AI agents, the reverse of what we're seeing today or what we're even building today.
Yeah. So I think the way I think of it is that AI still needs data. At the end of the day, the AI serves a human purpose. And so they need to learn more about humans and what interests us and what we like. And the thing about data is it is perishable, as in there is a long tail of where potential data has value over the long tail, but it diminishes very aggressively over time. And you can take a look at that, for instance, just when you look at what happened when first editions of ChatGPT came out, and they only had data up until I think it was 2021 or something. I forgot. And that was cool and cute about some stuff. But when you needed current stuff, you just didn't have that. And now every AI agent is basically just going up to current events because that's actually what's relevant and that's actually much more powerful. So data actually needs to be constantly replenished. And that, in a way, is what humans do because they're experiential. They have input, they have data, they have feedback, they have opinions. And that's actually how an AI becomes richer as a result of that. I know when Sam Altman talks about UBI, which, by the way, I'm not a believer in that, which UBI meaning universal basic income. The way that he's thinking about it is that AI is going to do a lot of work and it's just going to give everyone at least a minimum amount of money so everyone can live, right? And that sounds to me a lot like communism, except that your state is not a state, it's an AI agent. But effectively, it's still ultimately ultra-socialist. And we've seen how that turned out. So we're not fans of that. However, the twist here is that it's still income. It's just not universal. Because at the end of the day, for humans, we still want to show our worth. Like if we're just getting value for nothing, we see this today. We don't treat it with the same respect, right? There's this construct called mental accounting. I'm sure you've heard of this, right? And in mental accounting, we basically divide, even though it's the same source of money, it's the same type of money, call it the dollar. But from a mental accounting perspective, we basically categorize the money that we might have won in the casino or in the lottery or given as a red pocket or as a gift versus the money we worked for differently, even though it's the same money. And so we respect it differently. And that's partly because of work and because of dignity, and these things matter. You want to be able to have something that you've earned in a way, right? And so I feel it's a much better future where we're working for an AI agent, if to the extent that that's what you want to do, that's basically giving you value, maybe in the vein of a UBI, but you feel like you've done the work and you've given them something that's important for them. And that gives you status and recognition. And actually, that's actually what we seek for as humans. Yeah.
Right.
There is dignity in work.
There is dignity in work, that's for sure. And just talking about like that emergent space and how crypto has been evolving, there's been a lot of new protocols, whether they're layer 2 scaling solutions or cross-chain bridges. Be curious to learn if there's any that you're particularly excited about and which ones you think will be shaping the next phase of crypto's evolution.
So first of all, I think when we talk about the concept of L1 and L2s versus sort of app chains, shall we say, I do feel that we're going to have a lot more chains out there, as in having app chains, because the chain mechanism, and you could call it an L2, L3, whatever you want to call it, to us is a much better, more efficient type of open API. So, what Animoca today has over 573 portfolio companies. In the classic Web 2 model, that's impossible to manage because there could be individual investments, but how do they coordinate with each other? How do they create synergies? How do you create more efficiencies? You can't, because it's all very manual and I can't integrate it, and I need a special API. But if I'm building something on chain, we could invest in the protocol, or we could invest in a marketplace like companies like OpenSea or Magic Eden that are all part of the portfolio. You don't need permission to build on them. You could just launch a product and everything is on chain and the introduction is helpful. But actually the composability, the on-chain composability is essentially like an open API. So if you want to open up your infrastructure, your network, your system, your community, doing it on chain, we think is the best way to do it because there's a defined set of rules that you can basically compose and construct on top of it. And that to me is what's powerful here. So it's less about, I would say, purely which L1, L2 from a technology standpoint, there's some relevance to that, is really what communities do you activate that then have value from that, and you can compose it and build on constructs on top of it. And then, of course, there are, and this is the other benefit, there are communities and L1, L2s that already have audiences that you can address, and you can address them permissionlessly. You don't need permission. Like with Apple, if I want to address the Apple community, first of all, I got to spend 30% of that, even though the new ruling might change that for certain things. But also, Apple gets to prove whether you basically get to launch a product on the App Store that taps into your audience, whether on chain, you can do whatever you want, right? And every product that you put out in this free market environment could potentially succeed, right? Which means actually you just address a larger market from the beginning. as opposed to one where, it's more captive, right? So to that extent, obviously things like Ton have a large audience of users. So we like that. We back that as well for that reason. Obviously, like Solana has a lot of that liquidity, but you can't count out Ethereum, right? The largest amount of sort of DeFi TVL is still on Ethereum, and that's why it's the safe infrastructure, and people are building on top of that. There's new type of systems like what we're trying to do with Mochaverse or with Mocha ID that ultimately we think are going to be even more powerful, because digital identity is something that speaks to all of us. And that, again, if you thought about what kind of infrastructure would you want to build so you can compose freely on top of it, probably a chain type of infrastructure is better than just an API type access, for instance. And so I think to that effect, I think everything is going to be essentially a chain of technology of some sort, because it's just a better type of API access to your ecosystem.
Wonderful. As I think about that, I also think about how you, as Animoca, have navigated volatile crypto markets. And in that navigation, I wonder how you measure the performance of your over 540 plus portfolio companies in terms of asset growth. Are there any trends you'd like to highlight to investors?
Okay, so first of all, obviously we do track the performance. The typical performance, obviously, things like growth of users, growth, if it's DeFi related, TVL, how many people doing activities. Those are obviously, to me, those are fairly obvious ones. So perhaps they're, maybe to me, they're the least interesting part because they're the most obvious one, shall we say, right? Like, are you making money? Are you growing as a business? What's the user adoption rate, right? These are all important. I think these aren't the unique measure around Web3. What we look for if you're building something in this space from a growth perspective is what amount of financial inclusivity happens with whatever it is that you're building as a product. So meaning the per user wallet, how more deeply entrenched do they become within that financial ecosystem of sorts that you're building. So the success metrics then are based around that. So for instance, in case of student loans, it's easy. How many people are getting loans? What's the loan size? And how much capital are you able to provide for lending is an example of a success rate that might come from that, because the revenues will derive around that. But the other one is also, so when you see about mass adoption, how many users are onboarded, it's not good enough to say how many users are onboarded. It's important to say how many users are onboarded who then have a financial stake in what it is that you're building, because they own your token, or they're staking it, or they're creating yield from it, or they're engaging with it. So the tokenized aspect, that utility, that function, that distribution, that's the thing a Web3 company has to always measure, which is very different from Web2 companies, because the token, a lot of people conflate token like as a currency as opposed to something that extends your network effect. And so they say they focus on the utility of the product and they completely ignore the token, which they view really just as a financial sort of vehicle for monetization, right? And we saw this, for instance, in the first generation of many Web3 games making the same mistake. And therefore not just are alienating sort of the token holder base, but also not really able to harness the true power of Web3, which is basically how the token economies engage with your product as one of ownership and as one of addition to a financial system. And this kind of goes to the other perspective, which is that Web3 financifies everything. Essentially, it commoditizes what we used to call as a category fintech, right? So in the same way that AI is going to be not irrelevant as a construct, but irrelevant as a term, because everything has AI, we think the same is true for fintech, as in we're not going to distinguish a fintech company anymore because fintech is integrated into everything we do, right? Because of tokenization, right? And so right now, how we measure that success is essentially how much more financial onboarding are you able to do with whatever product you're building, right? So if you bring 1 million users, but they're not financially onboarded with whatever you're building, it's useless. There's no point. You've not succeeded. Versus if you only have 10,000 people come in, but they are financially vested in you and they're financially engaged, they've leveled up their financial literacy because of it, then that's very valuable. You saw this with things like NFTs. Thousands of holders of NFTs demonstrate more utility, more product use case, more volume, and more activity than 100,000 or 200,000 gamers who don't own anything.
Yeah, I've got to say that is pretty powerful and resonates with me. What amount of financial inclusivity as a KPI, I think, is really the basis of what we're doing in this space. If you're not making any impact, if you're not changing, if you don't have the backbone or initiatives like Open Campus addressing key financial issues for folks' everyday lives, then what is the point of what we're doing? Yeah, that definitely resonated with me because it's important to think about how you're financially onboarding folks into your project or your community to solve their financial issues. That's one I'll definitely
And
take away.
leveling up financial literacy, I think, is a key point here, right? So financial
Right.
issues being one thing. One of the big problems we have in the world, and this kind of comes to the early first question you asked around stakeholder capitalism, is that we're really divided between two types of people in the world, I would argue, ethnicity, religion, nationality aside, of course, right?
Right.
Which is you have one group of people who are true capitalists. They understand money. They just happen to be a single digit percentage of the world. And then you have the rest of the world, which is still basically stuck in the labor theory of value. Okay. And again, there is dignity and honor in work, but it's not feasible that you can only exist through work if the world is capitalist. As in, you need to own stuff and you need to have some type of capitalist endeavor, as in you need to be an investor of something. And I would also argue that as humans, we're generally actually geared towards investing. I don't mean investing purely as a monetary aspect, but we invest in our relationships. We invest in our friendships. When you go on a date, that's an investment, I'm not talking about in money, but in time and in effort. We take risks all the time, right? So I think that's very natural to us as humans. But then when it comes to money, so many people do not take that risk because they don't understand it. And it feels dangerous and it feels volatile. And so I think teaching this financial literacy is so important because that's how you leave people behind. Those who don't understand money are the ones left behind. And that's what we see today. They're the ones who don't have the means. They don't understand. And they look critically at the people who have the means because they knew something that they didn't. But it's not that difficult. So I think, again, this is where Web3 will completely, I think, certainly more democratized, but I think will create billions of people that have more financial literacy and therefore more financial inclusivity, in the same way that digital literacy and general knowledge was democratized in the first wave of the internet.
100% agree with you there. And yes, there is that delineation between literacy and solving the financial issues. I'm going to just continue on the Animoca and talk about your most recently completed audit, which is very unusual in our space. Would love to hear about your experience, and especially in this environment where everyone seems to be gunning for IPO.
Yeah. So first of all, the reason why I think our audit that we just completed, which is a good audit and also one that showed sort of our assets and revenue recognition, everything, is unique because right now the kind of companies that you can audit in crypto are either Bitcoin miners, Bitcoin holding companies, because that's pretty easy, you just hold stuff, or exchanges, right? Because that business model is somewhat well understood. But when you're issuing tokens, when you're generating revenue from the activity of tokens, that's actually much harder. And then when you make hundreds of investments, in our case, over 570 in our case, how do you audit that type of stuff, right? Because I also believe, to this construct that I earlier shared from the point of view that everything's financified and fintech is not going to be sort of a specific term because we're all going to have fintech in our businesses in one form or the other. That means that every company, every business will also be an investor in many things. Like I know traditionally we would try to delineate between I'm an operating business, I don't make investments. Investments is something else. I don't think that's true anymore. I think companies are going to, that our operating business are going to be some of the biggest investors in space. In Web3, certainly that's true, right? Like we're an operating business, but we're the one as a carry the largest investor in Web3, which just doesn't happen in Web2. Like how many companies has Apple invested? Like almost none, despite the fact that they basically have $160 billion of cash or whatever amount it is that they have, right? So that means that you need new standards and methods in which you can navigate that. And really, up until recent years, auditors didn't really understand how to audit essentially tokens and crypto. And they're trying to fit it into the right type of GAAP or IFRS rules or whatever it is that they're trying to put together. And that's really been challenging before. And remember, back when we first started into space in 2017, 2018, good luck finding an auditor that even understood what crypto was, right? If your audit partner is probably looking at this already very skeptically. So it's very hard, not even just to audit the technicalities. It's also hard because of the prejudice that might come, right? And so the auditor we use, Hal Chadwick, actually did a great job because they actually had already audited crypto companies before and they understood the space and had people in the team that own crypto. And that's the important part, right? Like it's really hard to audit a business in which you're completely remote and unattached to and have no idea how it functions, because then it just seems weird, right? So I think the way that we do revenue recognition on tokens now, the way that we look at assets, the way that we handle basically a balance sheet and off-balance sheet assets, these are, from as far as I can tell, new standards that have been developed that no other company has yet had to do. And so I feel like we're pioneering sort of the space in terms of making essentially a role model of, okay, this is perhaps under these accounting rules, how I would be able to now audit and review a business and recognize that revenue, for instance, as an example, right? I think that's quite pivotal. And I think we're the largest company in space that is, again, not an exchange or Bitcoin hodler that has done an audit of this size and magnitude.
From that experience, do you think that there was some learning on the other side of the table? And by that, I mean, with the evolution of and the current change of the regulatory environment, particularly in the US towards crypto, do you think audits like that in future are going to get easier? And by extension, how do you view what's happening in the US from a regulatory perspective? Is it positive? Is it
I think it's very positive.
Cautiously optimistic?
Yeah, first of all, what's happening in the US for the crypto industry is incredibly positive. So I think obviously there's some quirks just because we have let's call it dynamic presidency in America, right? So can't deny that. So never a dull day, shall we say. But on balance, of course, very positive, right? So obviously there's not that sort of previously hostile regime, especially with the SEC, that so many crypto companies in America had to deal with. And it's really held back innovation in America because so many companies were scared to tokenize or do anything around tokens because they were afraid that maybe it'd be considered a security or they go after them. Even NFTs basically were targets, even though in some cases they probably were clearly not security-like, unsecurity-like at all. So I think, sorry, well, I just came right over the tangent. What was the question again?
Yeah, I just wanted to get your thoughts around like folks on the other side of the table during your audit experience.
So first of all, I think it's going to just get better for all industries because you're going to be dealing with other people in the audit team who have crypto or have engaged with crypto or have audited crypto firms or have that experience, right? So it's a little bit like, how do you audit gaming companies, for instance? Traditional gaming companies actually had some struggle auditing as well because the auditors didn't know how to deal with virtual currency. And they didn't know how to account for that because the original gaming business model wasn't selling of currency. That happened really much later. It was subscription-based. So that was easy. Or selling a disc, right? Which is essentially like selling a product, right? So those are very easy to understand. But then when people started selling virtual currency, they didn't know how to deal with that. So for instance, there's a company in the video gaming space called Roblox, right? Which is basically the biggest game company by numbers of users, not as a business, but by number of users. I think 380 million monthly active users, pretty damn big, right? And when you look at their financials, they always make a loss. However, their cash flow keeps growing. And so they coined this term around this definition of deferred revenues, which we ended up using at Animoca as well, because the auditor, to fit into the accounting rules, had to basically define that selling of virtual currency was something that was essentially almost like a liability. So even though there was no recourse, and then there was an amortization period, which we describe in our audit files as well, in which eventually one could say that a token is being used over some average period of time, in this case, 18 to 24 months, for instance, right? So these are ways in which people can then understand how revenue recognition works because the service hasn't been fully rendered, one may argue, and therefore there's an amortization period around that. Like these are things that require not only familiarity to the gaming industry that you could then maybe apply to our industry because you could make reference to that. It requires the audit team to be comfortable with that as well. And if your auditor might only have been dealing, let's say hypothetically, in, let's say, rare minerals, then they would be able to audit a company in the digital space. And so as more and more people do it, there's more familiarity and there's more sort of talent, then it becomes easier and easier. And we're very fortunate to have a very good auditor here, but I would say they are still fairly rare, comparatively speaking, but it's growing. And so over time, it's just going to get easier and better, I would say.
Fingers crossed. And I just want to start to wrap up here. Wonderful insights from you, but just wrap up with last two quick questions here. One, would love to get your thoughts on your vision for Animoca Brands 2025 and beyond. And then what else in crypto excites you?
So first of all, for Animoca Brands, we have a lot of key projects that we're pushing forward outside of our investments. Of course, Bookverse digital identity, very critical for what we think is important to create a much more trusting web one of the problems that we have essentially, I think, in Web3 is that we've taken anonymity to that next level extreme case. Unfortunately, not for the right reasons. I think a lot of people, it's not to say that we shouldn't respect anonymity. It's to say that the narrative around anonymity was, I would say, co-opted by people who want to be anonymous for the wrong reasons. But we want to respect that. That's why digital reputation, which is what Mocha was trying to do with digital ID, I actually think it's a solve for that. So meaning that I don't need to know your name, I just need to know your reputation. And you can build up your reputation or lose it, right? Almost like a kind of quasi-credit score, but more around reputation index. So that's a big thing that we're super excited about, because if I can start doing business, think about it, right? If I can start doing business with a stranger around the world, and I know he has a good reputation, it's just so much easier. And really what that ultimately opens up is unsecured credit, which does not exist in crypto today. Everything's over collateralized. Why? In the physical world, basically unsecured credit is actually huge. It's trillions of dollars. But in crypto, it's not. Everything has to be over collateralized, because at the end of the day, because of the anonymity, I actually can't really trust you. Therefore, I need to see that collateral. Yes, there's that trust element. So I trust your assets. I don't trust you as a person or as an individual or as an agent. And so we think that's the next area, because we go back to this principle thinking around property rights. What is the most important property right that you have? It's the property in your own name. It's the property of your own reputation. That is the most valuable thing, right? And if we can somehow enumerate that value on chain, which is perfect for this, then actually there's a lot of benefits that can flow from that, right? Like when you do business with someone, you want to see his reputation. You do a reference check, you figure stuff out, right? And what's the one thing that we spend money to defend and protect? It's our reputation, right? So we think that's going to be super important. Now, we already talked about student loans, so I won't delve into that too deeply. I would say we remain very bullish on gaming, and we think it's going to be a big narrative closer towards the end of the year and next year. And people might say, oh my goodness, look at gaming. Gaming has the highest number of on-chain activity today at roughly 7+ million daily active users, right? So for people who are doing stuff on-chain, that's actually, gaming is actually the largest reason. But we conflate what's happening on-chain with crypto activity that's happening off-chain, as in an exchange, right? Because there's about 400 million people who own crypto and they trade on exchanges. And there's less than 100, more like 60 or 70 on-chain that are doing on-chain stuff, right? And we care about on-chain futures, right? So when you mix the two together, it appears essentially that gaming activity is not that big, but actually when it comes to on-chain, it's the biggest activity. But tokens, because of their financial nature, don't just express your ecosystem. They express sentiment of what's happening in your industry, right? So when AI is hot, AI agents and AI tokens do well from a pricing standpoint, but it doesn't mean that there's more people using AI tools on chain. It just means that the investors are essentially basically purchasing these tokens based on sentiment, much the same way that Polymarket kind of gives an indication of where the intention is in the world as well. So that's the power of tokens, which means that for gaming tokens to really do well, we have to make an assumption that the gaming industry is going to have a much more positive sentiment that it has currently. And a lot of people who are not in gaming don't appreciate the fact that post-COVID, gaming has had it really tough, not because of what's happening in crypto, but because generally it's been on the decline because of audiences. And more importantly, money has been heavily inflated because of QE, but gaming costs have remained the same. So in real money terms, gaming companies are making less money than before, even though it's a $200 billion plus industry. And so they've seen no growth, right? And so that's changing as well. And of course, the launch of GTA 6 is going to drive a lot of new gamers and adoption, console sales. And of course, they're going to try to push the pricing probably from what we hear to over $100, which means that basically we catch up to inflation in gaming. So these are some topics that we're super excited about. So many things we're excited about. So I'll probably leave it at that.
This has been very enlightening, and your time here with us has been very insightful. We really appreciate you coming, and we'll look forward to your continued success in the space. And we're looking forward also to having you back on the show soon.
Thank you so much.
Hey, everybody. Thanks for listening. If you enjoyed the episode, go ahead and give us a good 5-star rating and subscribe wherever you're getting your podcasts so you can get all the latest conversations from the most interesting founders, builders, and investors from across the world. Thanks so much, and have a good one.